Hi, everyone. Welcome to the Walk to Wealth podcast. If you're tuning in on YouTube or any of the podcast directories, we just ask you one teeny tiny little favor. If you find any value in this episode or have found value in the episodes prior, we just ask that you refer us to a friend. We are trying to impact as many lives as we can on their walks to wealth. Without further ado, we have a super special guest here. Zach, for anyone that may not know you, tell us a little bit about yourself. Who are you? What do you do?
Awesome, John. Thanks for so much for having me on. I love the concept. I love your name. Just the whole idea of what you're doing. A lot of value here. So I'll make sure to share it with many friends. So my name's Zach Lemaster. I'm the founder and owner of Rent to Retirement. We are a turnkey provider and operator, probably one of the larger ones in the space today. But I didn't start in real estate. I have a background in healthcare. John, my wife and I are optometrists by education. We went to school for many years to do the optometry thing. I was in the Air Force for 7 years under scholarship, so practiced optometry there. I invested in real estate the entire time. First house I bought was a duplex, did some house hacking. Next year, I bought 2 more duplexes. I got the bug. I like the idea of building wealth and additional cash flow just through real estate. One thing I always tell people is we've always bought, and this is still true to this day, that last year was a big one for us, but we've bought more and more real estate every single year since we bought that first duplex, which was about 15 years ago. And so eventually that got us to the point where we were able to retire from our active profession as optometrists just through our passive income through rentals. We had a lot of people that are friends and family and colleagues that were like, hey, we see what you're doing. We want to do the same thing. We don't have the time and energy or know-how. Please help us. We want to invest with you. That led to the birth of our company now, which is Rent to Retirement, where we assist people in buying turnkey properties following the same process that we have across 11 different markets. So that's about the quick and skinny of it.
Yeah, and amazing, Zach. And also, honored when you guys reached out to hop on the show. I was like, Rent to Retirement. I know that name's from somewhere, and I've heard you guys pretty much in majority of every Bigger Pockets episode, at least dropped in there some way, somehow. A lot of people know you. So as soon as I put 2 and 2 together, I was like, this is the same guy from Rent to Retirement. Oh my goodness, sheesh. And so, Zach, I kind of want to go a little bit in depth into, you kind of touched on your story a little bit, how about you and your wife and what you guys got going on. But, tell us a little bit about your walk to wealth, when it started way back when to your childhood. Like, what were some financial beliefs were going around in your household about money and things like that?
We're getting deep here, John. We're going to go into the psychology. And I think I was very similar to most people in being brought up with just their traditional means of retirement. I mean, we work your whole life, right? And the potential you can retire at some point. Hopefully you're healthy enough to do that. But I think that really growing up, it was very much, I was, I guess, in a middle class family, maybe lower middle class, something. My parents were electricians. They worked extremely hard. They always told me, don't be an electrician, go to college. I was the first one out of my family to go to college, but in which I felt proud of and they were very proud of. But they always told me, work hard now so you can enjoy life later. And that simple rule I've applied that to everything in my life. And I'm still working hard, but it's all about preparing yourself for the future. I read one purple little book called Rich Dad, Poor Dad, which all of us can relate to in most cases. And that was the first time I was really exposed to a different way of thinking about money. I really resonated with me. And then I read 20 other Kiyosaki books and, joined his cult. But I basically just wanted to acquire cash flowing assets. And I think that was really what set the foundation for us and just hit the ground running. We don't do any investing outside of real estate. This is the only thing we do because we know it and we've been successful with it. But it was a mind shift change, right? Because it was a tough thing for me to step outside of the traditional path of, being an optometrist and operating as a doctor in the healthcare industry, because you spend a lot of time and money to go through that. There's a lot of people that didn't agree with that decision early. But I made a point early on in my life too, that I wanted to at least create financial independence. I never had a plan to be really wealthy. It wasn't about that. It was just about control of my finances. My father, unfortunately, got sick and got ill, worked his entire life, extremely hardworking, multiple jobs and everything. And unfortunately, he got sick before he could even enjoy his retirement. And I just, that was never going to be the case for us. And so I wanted to work hard now. And, and here we are. I'm glad that we did.
No, that's an amazing story. And you kind of dropped in a little bit there how a lot of people didn't agree with your decision. It reminded me of that poem, The Road Less Traveled By. I don't remember the majority of the poem, but I know like the one of the lines is we took the road less traveled by and it's made all the difference. And now you're sitting in a position where you're doing a lot better because you took that road despite what had to say. So what kind of were what did you hold on to? What kind of mindset shift that you had to make in order to, despite everyone saying you're going against the grain, for you to keep on pushing through and see it to the other side?
I think eventually, John, it's just a matter of like not caring what anyone else says. I always here's the thing: everyone has opinions that they're willing to offer you, and you need to be very cautious of which opinions and advice that you would listen to. Many times, the people giving you advice are people that are not in a position that you want to be in, right? So I'm very careful on who I take advice from and who I actually care about what they think, and that's really always been the case for me. If someone is, and this is why I was a troublemaker in school, and I think this is why I had a hard time with teachers and authority in general. But if someone is telling me about how to invest my money or to plan my financial future, and they are not financially successful, then I'm probably not going to take their advice super seriously. But I'm going to seek the advice of people that I look up to that are in a better position than I am, and I want to obviously learn from them and emulate them because they've done it, right? They have that track record. So there's a lot of people that were telling me different things about what I should be doing and what my future is look like and the risks. But those people weren't real estate investors. They weren't multimillionaires. They were individuals that were, still stuck in the 9 to 5. I think today's generations probably that we're moving into a different place in our society where people can work from home. Most people have some sort of like multiple part-time jobs or side hustles on the online community and influencers. Like this is becoming a lot more relevant now where the old 9 to 5 job mindset, I think is kind of outdated. And so it may even be easier for the newer generations to, I guess, be open to or be accepted with the idea of being an entrepreneur and investing in alternative means. However, I think it's more difficult to be very focused for them because there's so many different things. So I don't know if that really made much sense, but I would say for the newer generations, don't care so much about what people think and stay ultra focused on, deciding on a specific goal and not getting the shiny object syndrome and bouncing around to 1,000 different things. Because you can do, and this is the same with real estate. You can invest in real estate and be successful in real estate doing a ton of different things, but you can't be successful doing them all at once. You got to stay hyper focused on one asset class and one individual thing.
Yeah, so let's time travel a little bit back to when you bought that first one back 15 years ago. You were in the real estate industry, so this was something that was kind of out of your ballpark, but you knew you wanted to invest in it. What was it like buying that first property? Just learning about it, studying. How long did it take you from like thinking you wanted to do it to actually like pulling the trigger and signing the contract to put an offer in? So tell us about, that your story around there.
I'm the type of person that usually when I set my mind to something, I just do it. And that's bit me in the ass a lot with, losing money sometimes, but it's also allowed me to be decisive and to take action, which is, I think, extremely important for people to be successful as entrepreneurs and in the real estate space in general. But the first house, this is as soon as I could get a loan. So I left left the optometry school. I graduated, which I didn't, I worked part-time jobs, but not enough to qualify for a mortgage. So I joined the Air Force. That allowed me to have the VA loan, which is a great loan, no money down. I would say I bought my first house probably within 45 days of joining the Air Force, like full time and being stationed. I put an offer on a house, didn't even see it. So I don't think it was much of an obstacle because I had mentally committed like, hey, I'm going to buy a house in this area because I'd already been thinking about real estate investing, listening to podcasts and reading Kiyosaki at least a year prior to that. So maybe that was the build-up time. As soon as I was financially able to buy that first house, I just did it immediately without even seeing it because I knew that I wanted to use a VA loan. I wanted to buy a house. I wanted to buy a duplex specifically so I could have someone pay my mortgage for me. I didn't like the idea of throwing away. And I'm super happy I did because three years later, I moved out of that house. I kept it as a rental property. I ended up refinancing it and eventually sold it. But I think it appreciated over $200K over a short period of time and, allowed me to live for free. So I jumped into it right away. I know a lot of people get the analysis paralysis and maybe get stuck on that, but we're all guilty of that from time to time. But sometimes you just got to pull the trigger and move forward.
Yeah. What were some of the things you would probably do differently if with all the knowledge that you have now from doing it so many times? What are some of the things you would have looked out for? Some of the things you'd be like, hey, maybe I shouldn't do this or,
I've given money to a lot of people that I shouldn't have, that I've lost the capital on. And this was partnerships. I've jumped into partnerships too quickly without having a little bit of a dating period with people before we got married, because partnerships are a marriage. And so partnerships are a great tool to bring in people if you have limited capital, to bring in people with capital but some people just jump into partnerships arbitrarily because it's like, hey, let's have this idea. We're buddies. Let's do this. I would be very cautious into jumping into partnerships. I've seen more partnerships fail and become ugly when they have to dissipate over time than people that have had really successful partnerships. So I would say that's one thing is just waiting and making sure, like, and sometimes this takes years, which not everyone has the patience for, but make sure that you're really compatible and your goals are aligned and things go well for quite some time. I would also vet people before, if you're looking at potential like syndications or private money loans, things like this, or just giving people money in general, take some time to thoroughly vet them out. And we've lost a lot of money in providing money to people that looked good initially on their track record, and then something happened, and sometimes not to their own fault. They failed. We bought a lot of deals we've lost money on too, John. I mean, one of my mentors always told me that in real estate, you either make money or you learn, because he refused to say that you lose money, but that's really what that boiled down to. So we've learned a lot of lessons. And typically with rental residential real estate, we bought a lot of properties that were in low income areas because the numbers looked great on paper, but they were a managerial headache. And we tend to avoid that asset class now. So I guess those are a few key points.
Yeah, and so I guess what would you look for in a partner? A lot of people, especially younger, they know they don't have any capital, so they run around asking for with signs like "Please, feed me." Pretty much just asking people for money, essentially. So what could the younger people do to make them look like a better, more qualified partner, although they don't have the capital? And what, when they're actively looking, should they search for, so that they don't run into someone that wants to take advantage of their youth, their energy, and their time?
Yeah. So two things: how do you make yourself more attractive to bring on private
Hmm.
capital and money or a partnership, and how do you vet someone and look for the right partner?
Hmm.
I think let's start there with the latter portion of that. In looking for a partner, the first thing you should do is think about if you actually even need a partner. Again, people jump into partnerships, I think, too arbitrarily, where it's just a matter of, hey, this is a cool idea. Like, hey, this is my buddy. Let's do this. Or, you want to, when you really, the best partnerships and marriages happen when you have opposite skill sets, right? But your goals are aligned. So this is important to know about yourself too. Sometimes some self-reflection is important to know. What are my skill sets? What are my strengths and my weaknesses? You want to support and give yourself the time to build on to really just run the parts that are your strengths, and then hire in your weaknesses. And that could be an actual hire. In fact, in most cases, it may make sense if you're running a business to actually hire that person instead of partnering with them. You do not have to give away your equity just arbitrarily if and a lot of people do that. So we tend to try to hire before we partner. But you marry people that have those common goals, but will fulfill the weaknesses that you have. So you have an all-encompassing business model that will be successful long term. In terms of making yourself more attractive, sometimes you got to fake it till you make it, right? And so that's okay. But also you need to be transparent with people, and you do need to be just completely real. There's so much, and this is another thing with it, I don't want to date myself here, but just with generation coming into this social media space, like there's so much is fake, right? And people see through that. And it's important to be candid, to listen more and speak less. And actually, if someone is further along with you and they're successful, but they see that you're eager and willing to learn and professional, and will actually, if they tell you to do something, you report back to them and tell you that you did it, like that's what they want to see, right? So when making sure that people are genuine is huge. And I think that's how you make yourself more attractive, even if you don't have that experience. If you do have the experience, then you still be professional and you still listen to conversations, but you also want to showcase that, and track record is huge, and making sure that you're not being taken advantage of. Well, I don't know how to answer that question, but actually sometimes it's okay to be taken advantage of as long as you're learning during that process, right? Like, sometimes you got to give more than you receive if you're lacking experience, but eventually, you want to make sure that it's a position you want to be in.
Yeah, definitely. I posted a reel from another podcast episode I had about, it was like 3 or so weeks ago from the time of us recording this. And it was funny because one of my good friends, Brandon, he was saying that something that he did is that he worked for someone, he was making an example. He was like, would you rather work for the guy that pays you $10 an hour or work for the guy that pays you nothing but makes 10 times more than the guy that makes $10 an hour? And a lot of people in the comment sections were pretty much like, "Oh, capitalistic, something BS, blah blah blah," and they were upset and they couldn't grasp their head around the fact that although you're not bartering with money, so it doesn't look like it's an upfront, reward. That knowledge, as you said, that experience, it may seem like you're getting taken advantage of, but that'll pay off in dividends in the long run because you'll be able to skip the learning curve because you won't have to go through any of that stuff on your own. You could just say, "Hey, you did it. You're not paying me." They're gonna be more willing to give you free advice because it's not like once they start paying you, they're gonna give you less value because now they're actually giving you something. A lot of people that aren't paying you at all will be more likely to, give some free advice, at least from my personal experience. But a lot of people don't grasp their head around that concept of like, hey, that mentor, that coach, that whatever person it may be, could actually take you a lot further faster. So I kind of wanted to ask you, when you were first starting off, was there someone that you looked up to or mentored you or kind of like that you could at least bounce ideas off of when you were trying to purchase these deals and acquire more and more properties?
And just to hit on your point before I answer that, though, that's
Yeah.
huge, right? That's how internships work is really, you're paid nothing or minimal to learn, but the education, like, yeah, the job at $10 an hour, $20 an hour is not going to provide you with the education that working for someone who's going to teach you the path to build a successful business and empire. That's huge. I mean, so go out and do that. A lot of people don't, even if it means you got to scrape by a little bit or work a couple jobs. That's hugely important because it's all about education and investing in yourself before anything else. And it's just a weird perspective. For instance, going to college, I went to, professional school for 8 years and spent hundreds of thousands of dollars. But yet I still find myself sometimes like, do I spend $20,000 to $30,000 on a coach, or do I it's just a different mindset. But one or two nuggets that you learn from people, whether it's internships or not, or whatever the case is, that can make you millions of dollars over the long run, just with a couple different nuggets of knowledge. So it's really important. But for me, I did not have a strong mentor in the beginning. I had people that generally were investing in real estate, but a lot of it was figuring out as we go. And at school hard knocks, we made a lot of mistakes. We lost a lot of money. We made a lot of money, and it is, just stayed the course. And now I make it a point to surround myself with people, network with people that are in positions that I want to be in and are much smarter so I can learn from them. But starting out, I didn't really have that. And so I just kind of, trial and error, I guess.
Yeah. And so once you bought that first property, the duplex, and you lived in it for, I think you said 3 years or so, and you said you've also been buying more and more properties each year since, right? And so can you talk to us a little bit about like scaling? What was that like? Because that's essentially you're going from just owning a rental property and living in it, maybe having other pay for your mortgage to like now you're kind of operating a business because now you're acquiring more and you're not going to be living in all of them. So now it's just it's more than just your personal residence that someone else is help chipping in on the mortgage. But so talk to us. What was it like scaling? How do you kind of figure that out? What are some of the mistakes that you made that you would probably watch out for now that you have more experience?
I would approach real estate and anything you do as a business, even if it's a side hustle, even if it's a hobby, you really need to look at it as a business because it is. I mean, even legally and from a tax perspective, it very much can be. Even one rental could be its own standalone business. But we did run things initially as hobbies. I managed my own properties. I was pretty loose in terms of like vetting tenants, and of course that bit me in the butt. But we had, I didn't have accounting managers, and that's okay to start that because you have to learn it, you have to cut your teeth on it, and then you develop better systems over time. But eventually, the earlier you can start operating your rental portfolio like a business, the better off you're going to be. I encourage people, don't manage your own properties. There really isn't a lot to truly learn from that. I mean, if you want to learn how to interact with tenants and kind of, things like that, but you probably shouldn't be interacting with them anyways and changing toilets because your time is better spent trying to focus on activities that will earn you more money and help you scale your portfolio. Scaling was very slow for us, right? The first we bought our first duplex, and that was just using a VA loan and things like that. The next year we waited a whole year, but then we bought two more duplexes. And then the next year we bought even more doors for that. So, I mean, looking back, like we've scaled significantly to the point we're at, but it was a very slow path, and real estate is slow. That's okay. So many people want immediate gratification. You just got to be okay with the slow path of scaling. Now in our business, that's a whole different story, right? That's scaling our rental portfolio, which is buy a few rentals, buy a few more, save up money, buy a few more, save up a few more. Let maybe take out a HELOC or cash out refi on the properties we've owned for a few years that have equity, or maybe sell those and do a 1031 that helps you scale. And that's why real estate kind of compounds over time. But scaling a business too is a whole different story. That's like, that's probably a topic for a different day, because we could spend hours talking about scaling a business with the different levels and problems you experience.
Yeah, definitely. I kind of want to ask too, how, what are some of the key pieces? You mentioned your property manager, but aside from a property manager, what were some of the key pieces that you started to put in place as you started growing to make sure that you could spend more time actually getting deals and acquiring it and less time doing the day-to-day minutia?
It's a time management, focusing on the activities that are the highest production activities and hiring out for the people that are going to be the operational side. Property management is a perfect example of that one. We started wholesaling. I didn't mention that, but that was kind of my first like active role. Yes, we were buying these rentals and I had my professional W-2 job, but we were also actively wholesaling properties, which is basically finding undervalued properties, negotiating them, putting them under contract, and then selling that contract or assigning it to an end investor that's going to rehab it or keep it as a rental. And so you make a fee, you make a split between the B to C and the A to B. But anyways, so with that particular business, that's kind of our first active business. I used to go out and put out bandit signs, and, every Saturday morning or something, I'd spend half the day going to put out signs and do marketing. And then eventually I would hire that to a college kid locally that either wanted to learn, worked for free, or that I could pay, minimum wage to, or something that just, hey, they went out and gave them minimum instructions. They went out and placed these signs out. So it's just like removing yourself from activities that really your time is not optimal for, and then hiring in people to do that. And there are people that are willing to learn as you grow your business, and like going to local RIA groups and things like this. There's a lot of people that are willing to learn and provide their time just for that experience. And you're not taking advantage of them, because as we discussed earlier, there is a lot of opportunity for you to assist them. So I think that's the biggest thing, John, is just time management.
Yeah. And so you said too, like the first year you bought the first duplex, and then you bought 2 more duplexes. Talk to us a little bit about that, because I know with conventional financing, it's a lot harder to acquire more than one property, because then, with debt to loan ratios and all that jazz, it starts getting a little tricky. So talk to us about how you were able to start acquiring some of these properties and some of the financing strategies you use to get these deals under contract.
Sure. I mean, we did buy our first 10 with conventional loans. And when we talk about conventional, this is your Fannie Mae, Freddie Mac loans. Typically, those are, if it's not a primary residence, that, because we talked about VA, that's also a conventional loan. But when you're buying a pure investment property with your Fannie Mae or Freddie Mac loans, which you can have 10 of them at one given point in time. If you have a spouse and your spouse and you were financing them separately, you can, in theory, have 20. You can both be on title and joint owner. But the reason people like those loans is because it's the lowest interest rate, lowest money down. It's the most scrutinized loan in terms of vetting you financially. So it is an uphill battle to go through the underwriting process, but that is an attractive loan structure. So the first 10 we bought were just through conventional. Single family, you put down 20%, multifamily, including duplex, you put down 25%. So we saved up 25%, and then we would put it down on the duplex. As far as debt to income, often lenders can offset, if it's already operational as a rental, often they can offset the debt on the property with the income on it. So it doesn't have a real negative impact to your debt to income, your DTI ratio, which is just basically your income reducing your expenses. And most lenders want to see that below 40%. They want to see your expenses at or below 40% of your income to be able to qualify for that loan. But at least with rental properties, if they're already operating, like the turnkey properties we sell to investors, it's really a wash. If they have the down payment for 10 properties, they could come in and buy 10 at once, and it wouldn't make a huge financial impact to their DTI. However, capital is the most limiting factor for everybody. And so as we started to get limited in our capital, we had to be creative about more ways to build capital. And this was throughout going out and being an active investor, doing the wholesaling to build up capital, partnering with some people to come in as money partners, and us finding the deals. And then, of course, we stepped into the space of non-conventional financing, which is really the asset-based lending, where the bank is looking at the property performance, less about you, less scrutiny and the underwriting. Just means more money down and a little bit higher interest rates. So
It's and so once you started off with duplexes, were there a point in time? At what point in time did you start buying larger properties? And I know after four, it becomes technically commercial. So tell us a little bit about how you started getting larger properties, like more units, and then the financing there as well. Because a lot of people don't understand how that conventional financing and commercial financing are like, residential and commercial financing are like two entirely separate, leagues of their own in terms of the way they operate and how they underwrite.
yeah, and mainly what we buy now is commercial real estate. This is mainly commercial retail centers and large multifamily. And the financing is different. They're going to look at you globally and your experience, so typical debt on a commercial property would look something like, I don't know, 30, when we say loan to value, it's how much of the loan percentage the bank's giving. Typically they're going to give less money. So like with a conventional loan, you can put 20% down on a residential property. Often with commercial, while you can potentially get 20% down, more than likely they're going to want more money down, especially depending on where the income of the property is. Commercial property is valued differently. It's not based on an appraisal. It's based on the income of the property. So the bank's going to want to see historical financials to give confidence to their ability to lend on it. There's no such thing as a 30-year fixed. At least I haven't seen one yet. There might be out there, but they're all balloon loans, which means the loan may be amortized over 20 or 25, 30 years. That's what your payment is based off of. But the loan is due in, say, anywhere from 5 to 10 years. That means even though it's amortized over 30 years, you have your regular payment, the loan will be due in 5 years. You have to pay the whole loan off, or reinstate your loan with the lender. And interest rates will be potentially fixed for that point in time, or they could be variable for a point in that time. So you just need to understand the financing a little bit better, because it's more dynamic. And the banks, to offer the most favorable financing terms, are going to look at your track record. That's why I love people to start with single family. Turnkey space is a great way for people to get in and buy a few rentals and build their experience level. Because when you do go to a commercial lender and you trade up, because that's the path that we followed, is we built our single family and small multifamily portfolio, let those build in equity over time, sold those off, did a 1031 exchange, bought a commercial property. We were able to obtain commercial financing rather easily because the bank looked at our track record and said, you're a successful investor. I think it's very unlikely to get any sort of reasonable financing if you don't have any or limited real estate experience, and you walk right into a bank and try to, and that's whether it's conventional financing or not.
When did you make that jump from the residential world into the commercial world, and how was that like?
I think we probably invested in the residential sector for 8 or 9 years before we bought our first commercial building. And we still invest in residential. Residential is the most recession-proof asset class out there because it's a basic need. People need housing solutions, especially in the middle B class type of neighborhoods in the markets that we're investing in. So obviously that's where rent to retirement, our turnkey business operates, is in those Midwestern and Southeastern markets where you have population growth and economic growth and positive cash flow, landlord-friendly legislation, affordable taxes. I mean, we have all the criteria. That's where we started investing and built our portfolio. And now we actively find those markets where we want to invest in. But yeah, it was, for us, I don't think I was, again, I'm a person that when I set my mind to something, I'm just going to do it. So I probably thought about commercial 4 or 5 years prior to doing it. But once we were able to trade up our single family portfolio into commercial, we were able to step into that space rather quickly. And we like commercial because while the returns are less actually in the commercial space, it allows us some economies of scale. So we get to grow our portfolio quicker. And there's what's called cost segregation studies. So we do accelerated depreciation on those to reduce our tax liability. And that's easier to do with larger type of properties.
Yeah. And so then, for anyone that doesn't understand what cost segregation is, can you break that down a little bit and explain, how important that is to not having, how do I put this? To defer, I guess, taxes and kind of not have to pay them, which a lot of people think, as you said, the rich don't pay tax them more. And so you tell us a little bit about, tax segregation, a couple others, and maybe a couple other strategies that you probably use to offset that taxable income.
Well, taxes are the biggest expense that all of us are going to have to pay, whether you like it or not. And the government's always going to get their money. But real estate, and what people need to understand is that when you have wealthy people that are not paying, taxes, they're not evading taxes. They're following exactly the IRS code that the IRS has put into place because they want to encourage economic activity, right? They want to encourage something. The people that are out there developing and buying and improving properties, like they are a contributing member to society. They're creating jobs and they're improving other things. Like you get the tax incentives for doing those things by investing in those assets and improving them. And that's why they're getting those tax deductions. And eventually, they will have to pay taxes to some degree. So it's just a deferral. And there are some cases where you can ultimately defer forever, but just know that. So there's a lot of misconception out there, and people want to poo-poo the wealthy that don't pay taxes, but they don't understand the full concept of boot. But at least with cost segregation, this is basically where you're taking the accelerated depreciation on our property. One of the best things to know about owning rental real estate is that it's a depreciable asset. Even though it goes up in value over time, in the eyes of the IRS, it is devaluing over time. And that's because it's a physical asset. You have wear and tear on the property. Normally with a residential property, you devalue it at over 27 and a half years. And that's just the number the IRS came up with. So if you buy a $100,000 property, basically divide that value of $100,000 divide 27 and a half years. That's roughly just over $3,000 that you get to reduce from taxes every single year. With cost segregation, this is basically saying if you're a real estate professional, you can, and you're actively involved in real estate, you can take a portion of that in year one. And it's roughly, I don't know, it depends. You get an actual engineer study. You can do it on residential or commercial, but it allows you to take what's called bonus depreciation, which could be upwards of 25 to 30% of that. Instead of taking it over 27 and a half years, taking it 25 to 30% in year one. And so what that does is it allows you to reduce your active income. If you made $100,000 that year, your taxable income is $100,000. But if you bought, maybe 4 or 5 of these $100,000 investment properties, you could literally wipe out your entire taxable income for that year by doing accelerated depreciation, which would allow you to have that much more money year one to then go reinvest instead of giving it to Uncle Sam. You're actually taking that money and earning money on it and reinvesting it. That depreciation is recapturable. So when you sell that asset, you do have to pay that depreciation back. However, you can 1031 and further delay that. So I know that was kind of high level. Hopefully I didn't lose anybody on that.
Yeah, definitely. I didn't know that depreciation was, you had to 1031 in order not to pay. I didn't know you had to pay that back. So that's something brand new that I just learned as well.
Depreciation is recapturable. And the terrible thing is that if you don't take depreciation on it, like you are forced to take depreciation on real estate. It's a benefit. You want to take it because it reduces the taxes that you have to pay on your cash flow and whatnot. But if you don't take it, the IRS treats it as if you did take it when you sell the asset. So that's why it's important to make sure that you have a real estate accountant that knows what they're doing. You probably shouldn't be filing your own taxes if you're an investor. Because if you mess up depreciation and you don't actually take it, which means you didn't get the benefit, you still have to pay the taxes as if you did. And so that's super important. You got to make sure you have the right people that you're, guiding you on the tax side.
Yeah, definitely. And so you've been able to learn a bunch of these, cool strategies and that help you continue to grow your portfolio. If you could take us back to a little bit about the beginning of rent to retirement, I wanted to ask you, at what point did, your friends and family say, hey, Zach got something pretty good going on over there. I want pieces in, investing in real estate. And how was that like from your end, kind of figuring out that, hey, I know I'm doing this for myself, but other people want to do this as well. So kind of tell us, kind of how that started.
Yeah, I alluded to this a little bit in the beginning, John. This is rent to retirement was built out of our own successes as investors and people coming to us asking for help. We were investors that were successfully building our own portfolio out of state because, quite frankly, that is a turning point in our own investing that allowed us to really scale and become financially independent. Is the ability when we took the path of not just being hyper focused to invest in our local area because that's all we knew and felt comfortable with. We started investing in different locations throughout the United States where we were able to scale our portfolio much quicker and obtain better returns and diversify over time. And eventually, by doing that, after a few years of investing in multiple locations throughout the US, we were able to replace our active income and technically retire for all intents and purposes. But I'll never retire. I'm an active investor and I enjoy real estate. I thrive on it. But the thing is that we had a lot of people that were once they saw that and saw that, that what we were doing in real estate was real and legitimate, there was a lot of people that reached out and said, and these are friends from, optometry school, from college, family, of course, they were like, hey, can you help us? Can you show us what we're doing? We hear about all these different ways to invest in real estate. We're tired of the stock market. I don't want to just bank on a retirement or social security when at 65, whatever the case is. We want to invest in real estate. We need some assistance investing and building a plan and a strategy and some coaching and identifying the markets. We had already built that system investing ourselves. And so that's where we started to scale our business, already doing what we were doing, either building or rehabbing properties, leasing and managing them, and then selling them to investors that just want to be buy and hold investors and basically doing all the legwork for them, but they still get the benefits and financial benefits of actual property ownership. But that was the birthplace of our company, is simply a few people saying, hey, we want to invest with you. And the light bulb going off saying, well, we've only been focusing on our own investing. We have all the people and systems in place. We can easily scale this and turn this dial up. And because we get enough deals coming in, we don't take on all of them. So we don't monetize on those. Instead, we can still have a little bit of profit sharing in those properties, but also provide value to our customers.
Yeah, definitely. And so you mentioned that you went out of state because you have greater economy to scale. What was it like investing out of state? A lot of people tend to have that, they want it to be tangible. They want something that they could drive to. They want something that, they could physically go visit the property, in within a matter of, maybe an hour or two or some convenient sort of time in their backyard. Right. And, what advice would you give people that are looking to invest, are trying to consider whether or not they should go in state or out of state? Or maybe they have already invested in state, but are scared to take the jump out of state because, it's so far. What if I can't see it? What if the tenant and all these other, limiting beliefs? What advice you would kind of give to people that want to invest out of state, or why should they invest out of state rather than just sticking home their entire time?
Any successful investor that you talk to is going to have a diversified portfolio in multiple things, often multiple states, multiple investments. I would say that it is a limiting belief if you're thinking that you have to, or you should be only investing locally, because quite possibly you could build a more successful portfolio quicker in a market that is out of state, because there's, it's very unlikely that you just happen to live in the best investment market in the US. And so what we've done is actually been strategic to say, where are the best investment markets based on this criteria? And then let's go there and build our systems and teams in place. Because the reality is, John, that you face all the same risks that you do in real estate investing, regardless of location. Now, legislation may vary slightly in different locations, but I mean, all the tenant issues, things like this, like all the things that you mentioned, it doesn't matter if the property locally or not. People have this false sense of security of like, oh, if it is locally, I can go over and deal with it. Again, is that the best utilization of your time? Are you really the best person to be dealing with that? Does that cause additional stress that maybe you shouldn't need? I don't want to see any of my rental properties unless it's a short-term rental that we do own a few of. We go visit those properties because we personally use them. Any other real estate asset, I don't want to see it. I don't want to be close by, out of sight, out of mind. Now I want to have the established team to be set up to efficiently and effectively manage that. But I don't want it to be, a hindrance to us. I mean, obviously we want to make sure that we're confident, but in the area and the team, but what's most important is that we're investing because we have confidence in the market in that area. And so we're reverse engineering it to say we're investing in that area, not just investing locally. And again, that was a pivot point for us to really allow us to scale our portfolio over time.
Yeah. And so you kind of mentioned too about, legislation and population growth and job opportunities. Where could people start learning how to analyze which location is best fit for them? Once they conquer the fear, it's like, okay, I'm going to finally do this. But it's like, where on earth do I start? There's 50 states, so it's like, there's so many different places to choose from. What are some of the, ways that you guys go about finding this, information about for job opportunities, knowing which companies are going where, knowing where all the trends are going, where the migration patterns? What kind of sources do you guys kind of use to figure all this stuff out and analyze it?
Yeah, a lot of it is just, government data, census data. It's public available knowledge. We do have some sources that we pay for, and we actually have an entire team dedicated to identifying new market opportunities. But I think it's, don't overcomplicate it either. There's some general locations, like if you live in a very expensive market that maybe doesn't have the best landlord friendly legislation, These would be a lot of coastal areas, right? Not to say that you can't be a successful investor there, but maybe it's a higher barrier of entry. It's harder. We do a lot in the Midwest and Southeast. Some of my favorite markets in the Midwest would be Kansas City, Missouri. I've been investing there for 12 years. Super successful market. A lot happening there. We do a lot around the Cleveland area in Ohio. So these would be like suburb areas like Akron and Barberton. We do a lot in Alabama. We do new construction all throughout the state of Florida. State of Florida is probably one of the best markets there is for cash flow and appreciation. And there's no state income tax and there's landlord friendly legislation. It's just like, there's in Texas is a good example. The property taxes are high. So, I mean, I'm going off on different tangents, but you really need to develop a criteria. And I think invest in multiple locations. So maybe it doesn't matter so much where you start. More importantly, that you start with the idea of investing in different areas over time. But if you don't know where to start, I mean, visit a team like ourselves, right? For a shameless plug, go visit rent2retirement.com and look at the different markets that we've invested in because of the different reasons. Whether you invest through it or not, go and do that and talk to someone and at least learn. It's all about learning and then eventually taking action. But if you only have $30,000 to $40,000 as a down payment, maybe you can't invest in California or New York or Washington. Maybe you have to invest in the Midwest where that can still buy you a decent B-class property with that type of down payment. So just be realistic about that. Do research, talk to the right people, and then eventually build somewhat of a criteria and take action and buy the property.
Yeah. And so you mentioned about diversifying across location, and you kind of mentioned that you had a short-term rental, you have a bunch of, duplexes, you're into commercial space. What are some of the different asset classes that you can diversify within real estate then that are some of your favorites to use and why?
Oh man, there's so much you can do. Yeah. I think, you have single family and that's probably the place to start. I'm still extremely bullish on single family because it generally have better appreciation, better tenant quality, longer term tenants. It's more accessible it's more liquid. So when it comes time to sell the property, you can sell to a residential buyer who's going to pay the most for the property. You're going to sell to an investor. You have to get the best financing on single family with the least money down. So anyway, single family, great place to start, or small multifamily. As I mentioned, we did duplexes. And the commercial space, we operate mainly in the retail sector, which a lot of people don't like retail. I personally do because you get longer term triple net leases. It's extremely passive, but we're buying stuff at 5% caps. These are long term, and then it's a tax benefit with those. A lot of people really like multifamily. I do as well, although it's very competitive right now. I would steer clear of retail office because people tend to work from home right now, and we're seeing a lot of office repurposed, and also big box stores, like big box retail. People are repurposing those to storage units and things like that. I mean, that's an interesting niche. So that's kind of on the commercial side. Short-term rentals, I mean, this has been a super sexy space that a lot of people have been just buzzwording up and interested in is short-term rentals. Short-term is a really cool space though that we've become rather involved in. And we like to do this thing where we go in and find performing assets in the short-term space and then bring in better management that will then, increase the income on the property because we know we can manage it better. We work with and I'm partnered in this company with a boutique management firm where we basically go in and we're buying high-end type of properties, but short-term rentals, there's some people that like to start in arbitrage. I've personally never done that, but you sign a property, a long-term lease in a metropolitan area, and then you rent it out in short-term and then you make the difference, right? That's kind of a unique area. Creative finance is kind of coming up, and I think it's more relevant in this space. This is where you can buy real estate with no money or banks. Really, it's finding negotiated seller or finding deals and then negotiating with sellers to either hold the debt or take over their loan. This is basically lease option subject to acquiring a property, subject to existing financing, seller financing deals. Often these are deals, and we have done some of this where you're buying a property from someone, sometimes with potentially no money down, or it depends. I'm throwing out different terms. You'll have to look these up, but also, there's the traditional wholesaling and flipping. I think those models are maybe not as relevant right now in the market cycle we're in. So, but we're really enjoying the commercial space, still residential because that's your bread and butter and recession proof real estate. And then doing some value add in the short-term space.
Exactly. And, we've kind of been able to go through your walk, how you started with your VA loan, buying the first duplex, and then how you were able to move out, how you were able to start getting more, then eventually getting to the point where you got friends and family asking you for help and then starting your business and then branching out to other states and on a larger and more national scale. But to kind of ask you, what's one thing that any beginning investor or someone that aspires to become financially free, what's that one step they could do to move the needle a little bit further and push it a little bit further with all the information we kind of talked about today?
I think the biggest thing that I see holding people back is they get the shiny object syndrome, and they're just lacking the ability to be focused and take action. And there's one thing that drives me nuts, and it's just talking to people, and they have all these big plans. And then, and this is my family too. Like I said, it drives me nuts. It's family as we're getting closer to the holidays here, but it's like talking about stuff, and then a year or two goes by and we're talking about the same damn thing and they haven't done anything. So for me, I think it's just about action, and that can be small steps, right? If you're not in a position to buy your first rental, like make a goal, go out and build a side hustle and build up $10,000 or something, and do that until you have enough to put down as a down payment, or find a partner, create a wholesaling business, flip a couple houses, go out there and do something and actually take action, even if you fail at it. But at least you were focused and you learned, because I guarantee if you fail at something, you're going to make way more money back than you lost the next go around, just because you learned it. To be real successful in the real estate or business, you gotta have the grit, and you gotta have the grind over time. But that starts now, even before you really become successful, is just staying hyper focused and not taking no for an answer, and not stopping until you accomplish something. So I hope that I was able to motivate a few people to get some things done.
Yeah, Zach, you've been dropping a bunch of gems throughout this entire episode. You kind of mentioned it earlier, but where could we go to connect with you, learn more about what you got going on, and potentially in the future, once you start putting up some capital, invest with you as well? Where could we find you at?
People can visit our website. It's rent2retirement.com. That's rent2retirement.com. You'll be able to find out about our turnkey business if you're interested in being a passive investor and just buying turnkey, learning some of our processes along the way. But we do a lot. I mean, we're active in the commercial space, the education. We have creative finance deals. We have short-term stuff, syndication opportunities for people to invest capital. So, we have our hands in a lot. And I would say the best thing you can do is just go there, learn something, speak with our investment team. All of our social media links are on that website as well. So that's a good place to start.
Amazing. Now it's time for my favorite segment of the podcast, the final 4 questions, how we end every episode. Question number 1, what is the most impactful lesson that you've learned in life?
I know you asked me these ahead of time, and I don't remember what my responses were, John, so I'm going to go on the fly here. The most impactful lesson I've learned is probably I would say, on the partnership aspect that I was talking about previously. Just, you really need to know yourself, and you need to have a clear, defined idea of what your goals are, and you need to consistently take action towards that. But don't let anyone distract that from you. And maybe, before you jump into a full-on partnership, make sure that it's the right fit and work with people. And that is one thing not to rush, because that has set us back significantly, is rushing in with the wrong people. And it just is a lot of stress to unwind in time and energy.
What is the most admirable trait that you could find in a person?
I would say that grit, that hard work, right? And I think that's becoming more rare these days. So is just the ability to be humble and to be hungry, to go out there and really work and be willing to learn. And, that is a trait we look for people to join our organization all the time.
If you had to change someone's life with one book, which book do you recommend?
So cliche, but man, it's got to be Kiyosaki. I think I'll name a few here. So obviously, Rich Dad Poor Dad. I actually think another must read is Cash Flow Quadrant. That those two are in parallel. And then Kiyosaki has all sorts of other good stuff. And then The Millionaire Real Estate Investor by Gary Keller. I mean, if you're really specific about real estate, that one's just huge, and thinking about just building a long-term path. So,
man, final question: what is the legacy that you're trying to leave behind?
Man, I really get addicted to helping people accomplish their goals. It is a challenge, because sometimes real estate has its own challenges, and maybe this comes from the healthcare industry, but I like to help people not only, obviously see from the optometry aspect, but really just, I like helping people and helping them accomplish their goals, because that is the true reward for me. We don't do this for the money anymore. I mean, at one point it was all about the money, which is okay. But really what keeps me going is seeing people's success stories. And I love to hear the positive feedback. And man, it's cool. Sometimes people will invest with us to get their feet wet, learn real estate. They'll buy a few houses. They'll come back to buy a couple more, diversify or whatever. I won't hear from them for 2 to 3 years. And then I will. And then they have this huge portfolio in this business. It's like they're just killing it. And they tell me, the best thing they could say, those first few properties that we bought with your company and invested with you, that's what gave me the confidence to go out and do what I did. I love those stories. So that's what makes it all worth it.
Amazing. It get to the point where, I think it's like only once you get over $70,000 a year, each dollar you make over that doesn't increase your happiness, not a single bit. So you get to a certain point where servitude is the only thing that matters once the money is there. And
I
so
love it.
Zach, I genuinely enjoyed our conversation today. I took a lot myself just from being able to talk to you and kind of just use this podcast to kind of break down kind of your journey, how you went from investing in just a duplex to now helping, a bunch of other people get their real estate investing journey started and make their real estate dreams come true and help other people, slowly start their way into that financial independence, that financial freedom that we're all striving after. So I genuinely thank you for taking the time to hop on the show.
John, it's been a pleasure. Thanks for having me on, man.